Welcome back to another edition of the Prepper Recon Podcast. Our mission is to bring you great interviews with preppers from around the world so you can be better informed and better prepared for everything from a hurricane to the end of the world as we know it. This episode is brought to you by CampingSurvival.com. Whether your plan is to bug out or bug in, CampingSurvival.com has all of your preparedness needs, including bug-out bags, long-term storage food, water filters, gas masks, and first aid kits. Check them out online today at CampingSurvival.com. Be sure to enter coupon code PrepperRecon for a 5% discount on your entire order. Today's guest is David Morgan, the author of Get the Skinny on Silver Investing. He's also the writer of The Morgan Report and creator of Silver-Investor.com. David, thanks for coming on the show.
Well, great to be with you. Let me just add a little bit of what you just said, and thank you. It's not just me on the Morgan Report. There was a day when it was just me. Those days are long gone. I have two analysts, senior and junior, that help with not only the writing of the Morgan Report, but also ferreting out some of these mining tours and all that we go through to make suggestions to our readership, not only in what the metals are going to do, what they have done, and where they're going, but the whole report on money, metals, and mining. So I just want to get that out there. It is a team effort, and those are just the analysts. There are other people that work with us as well.
Very cool. And the Fed announced recently that they would be cutting QE by $10 billion per month. Were you surprised by the taper announcement?
No, I really wasn't. I was slightly surprised that they did it when they did it, just before the handover to Janet Yellen. But I think it's fairly meaningless at this point. And people say, how can, $10 billion be meaningless? And the reason I can say it with authority is that if you actually look at the numbers of the Fed's repurchasing of this toxic debt, seldom has it been $85 billion. That's the mandate. That's what they said. But if you look at the numbers, and I've actually gone through this in the Morgan Report that will be coming out this weekend. It's due the first Monday of every month. That's January 6th. I don't know when this podcast is going to go up, but from January 6th on, we show the actual facts where a lot of times they put $100 billion in a month into buying these toxic assets. So they take some of the rollover, some of what they have got maturing on their balance sheet, and use that additional funds to purchase more toxic debt. So the $85 billion is just a number, the same as the $75 billion, but the reality is they're spending at least that much on this waste material. And so from the actual factual perspective, the $10 billion cut is like a gesture that's going to maybe excite some people that really don't understand how the system works, and additionally to give some of our trading partners the idea that perhaps the United States has got some integrity and it might not just print money to infinity, but nonetheless the facts speak for themselves.
So it's just more jiggered numbers, I guess we could say. And I think the bond market, maybe they didn't get the minutes from the last Fed meeting, because Ben Bernanke said they were going to continue to target the 0% interest rate policy, but the 10-year rate shot past 3% last week. Does this have the potential to create disruptions in the market?
Well, not yet, but at some point higher interest rates will have the potential to disrupt things. I mean, if you go back and understand that the Fed sets the discount window, which is where their commercial banking friends can borrow at a given rate. And then, of course, the bond market is where they can park their money and they make the spread. So if you could borrow at 0.5% and get 1%, you're making that 0.5%. And then when you leverage that up by the way that the banking system is structured with fractional reserve banking, you can go ahead and get far higher returns than a half-point spread. And this is how the whole system is done. This is how it operates. So the point is, though, that the market actually sets the interest rates on the debt markets eventually. And no matter what the Fed wants to do, there are times when the market takes over. And that's what took place here on the 10-year note, is that it did move up over 3%, which is still very low interest rates relative to historic means. Nonetheless, they could get in a situation where, one, interest rates continue to go higher, the Fed has less and less control over that, and at some point, the market will say, something's not right. We have to remember that the debt market is the problem. the biggest bubble in the history of mankind is not the stock market. It's nothing more than the bond market or the debt markets. There's never been this amount of debt on a per capita or on a per government basis than exists right now. And since it's all basically funny money and it isn't really tied to anything of real value, the problem is that as interest rates go higher, debt or bond prices go lower. So it's sort of a self-correcting mechanism from the aspect that if interest rates were to soar, let's say they soared to 10%, that increase in interest rates would take the value of all the debt instruments, the bonds, the U.S. bonds or whatever, down significantly. And that would be deflationary. So there's a lot of intermixing between what goes on in the interest rate market and how it affects the economy overall.
Very good. And do you feel like our current economic system is sustainable?
Absolutely not. There's no evidence of it throughout all of economic history. All the recorded history that we've ever known shows one thing and one thing only, that a system based on a lie cannot sustain itself. And the lie is that you can create something for nothing. Basically, the United States that can't create something from nothing goes and borrows from a private banking consortium known as the Federal Reserve System at interest and uses that money as they see fit. And that borrowing by the U.S. government on behalf of the U.S. citizenry is done again and again and again. And other nation states are watching this and they're saying, when's this going to stop? How is this going to end? And history has shown it doesn't end well. I believe that that is the situation we are currently in, and I totally think that within my lifetime and not too distant future, it's going to end one way or another, and they never have ended well in the past. Therefore, I don't think they're going to end well this time.
So what does that worst case scenario look like in David Morgan's mind? Could we experience food riots or something like the Great Depression, or is it not quite that bad?
Well, it could, but that doesn't mean it would. It is a probability. And, we're looking at the probability. What's the chance? 5%, 1%? What is it? And I think, to be honest, no one really knows that answer. Once things reach a level where enough people feel an injustice, then we could see a breakdown where, for example, there is not enough food in the system or the prices are so high that the average family would have to cut back on maybe the type of food they eat or the amount even. And there could be something else on the side. For example, truckers might unite and refuse to transport food to make a point that their wages are not keeping up with the current inflation rate, or because the cost of diesel or gasoline has gone up significantly relative to other prices. So there's a very complex situation here, and we could bat around different scenarios all day long. Certainly you could Google them and you can read from the most dire to the most optimistic. I tend to be somewhat of a realist. I think there'll be areas in the country that will be worse to be in than others. I think any place that you have a high dependency on the federal government, you probably have a situation that probably will be more volatile than somewhere where people are more self-sufficient. But to sum it up, I say the more complex that a system is, the more points there are where things can be disrupted. And we have a very complex system right now. The distribution level, everything that takes place is rather amazing. In fact, just to digress slightly, but whenever I'm in a large city, and I live in a very modest sized place, as my main place of being domiciled. But as far as going to like a Hong Kong or a New York City or, one of these great metropolitan areas, I always stop and think how complicated it is to get all that food into all these places to feed that many people just on a daily basis, let alone the amount of gasoline and everything else. And these things click along just fine. And yet there are so many points of failure that could take place that don't. And they just go on. And not to say that there isn't, a sewer line that needs, repair or this or that that's constantly ongoing. But it's a rather complex system, and yet it functions very, very well. So, kudos to mankind in a way. Having said that, yes, as the system becomes more and more distrusted, that's where we start to see things start to break down, because people start to question, am I getting paid enough, or is this food good, or is this, all these questions. I mean, there are infinite amount of them really. So probably beat that horse to death, but yeah, it's going to be interesting. There will be places where you're probably better off than others, but for someone to stand up and say, this is the place to live, or this is how you prepare exactly, no. Take it all in, use your own common sense, realize that mankind has gone through these type of things in the past, and they've always survived them. So I think that's the attitude to have.
And do you have some expectations for gold and silver prices in 2014?
I do, and I've been consistent here in the last several interviews I've done in the last month or so, and I think we've seen the bottom in silver for sure. I think that we're going to see gold and silver both do better in 2014. In other words, the base has been built, will start coming up. I do expect I expect silver to get into the $30 range or higher sometime during the year. And as far as gold, I expect it to move above the 1550 level where it broke down, and probably 1700. But as I've done in all the other shows, I need to give the caveat, and that is if a black swan event were to take place, we could see prices move significantly higher and accelerate. So is that going to happen? Again, no one knows those type of things, but certainly there's enough out there in the global economic system that something could take place, and it could just, light these metals on fire. If you look at, and I do technical work, I put some credence in it, even in a manipulated market. It has its merits, and we're at such an oversold level right now that if you look at cycle theory or past areas where we've had markets that are this oversold, this is where you can get accelerations to the upside rather dramatically, and that certainly could take place. I wouldn't rule it out.
And a lot of our listeners are novices when it comes to the precious metals markets. Could you briefly explain what the COMEX is?
Yeah, it's the primary market for trading metals such as gold, silver, copper, and aluminum. It's 98% based on paper or derivatives trading, and occasionally it does deliver real metal, perhaps 2% of the time. It is responsible for setting the price in the U.S. markets. It's a contract market between buyers and sellers, and it's highly leveraged. Neither the buyer or the seller necessarily needs to have the underlying metals being bought or sold. However, if a buyer pays full price and does what's called stand for delivery, then the seller could be, but not necessarily would be, required to either come up with the metal or give the cash equivalent. So it's a papers game. It's basically almost all paper, occasionally real settlement. It's highly leveraged. Unfortunately, it is where the price is set for the metals. And so this futures market, where you're buying metal for a future delivery that, again, very, very seldom takes place, controls basically the price setting mechanism.
And how does that compare to the Shanghai Gold Exchange? Can you tell us a little bit about that?
Yeah, Shanghai is basically the same premise. It's just a different jurisdiction. But the Shanghai Exchange is going to be much more physically oriented. So there will be a contract basis, but the amount of metal will not be settled in paper like it is in the U.S. markets. It'll be much more settled in actual metal. It's new, and that's what it's purported to do. I do believe and trust that that is what will take place, but it is new enough where we kind of have to keep an eye on it and make sure what really transpires. A lot of times, the intent of something doesn't really work out exactly as it was anticipated, but from everything that's been written about it so far is in the Asian markets, and certainly Shanghai is one of the central points in Asia, will be much more physically oriented. So if that's the case, then obviously over time it could usurp even the paper markets if the amount of physical is substantial, and I expect that it will be.
And then can you give us a brief overview of what the London Bullion Market Association is?
The London Bullion Market's a wholesale over-the-counter market for trading of gold and silver. It's conducted amongst members of the London Bullion Market Association, loosely overseen by the Bank of England. And it's done by a price fixing mechanism. And this involves gold dealers from London, from the 5 bullion banks, establishing a common transaction price for a large pool of gold purchase or sale orders. It's done twice each business day first at 10:30 a.m. London time for the morning fix and 3 p.m. for the afternoon fix. The participating bullion banks act both on their own behalf and those of their customers, and they have limit orders purportedly that they use to trade and adjust the London gold fix. It's been going on that way for a very long time. What's very interesting about the LBMA is if you do a study on the morning and afternoon fix, it is so biased that it cannot be within the realm of probability. I think for some of the listeners to do is to Google LBMA price fixing Adrian Douglas. Adrian Douglas, who is now deceased but worked with GATA for some time, and one of the people of GATA that I most appreciated, and I like many of them, I don't know them all, did a detailed study on the price fix and how it was impossible to have the discrepancy between the AM and the PM fix on a random basis. So take that as you want, study it on your own. I think I've said enough about it, but these markets are not all that free. And I mean all markets, not just the gold and silver markets, which most of, my listeners pay particular attention to, but even the stock market, the bond market. I mean, look, this LIBOR thing with this, fixing of interest rates. I mean, interest rates are kind of the key to the kingdom. The debt markets are the biggest markets by far. The debt markets is where the bubble is. The debt markets is where things are going to explode and unwind. This is the problem. The debt market's the problem. Gold's not a problem. Gold's a solution. But nonetheless, we are going to see more and more facts come out that most of these markets are rigged. I mean, it's unfortunate, but this is the way reality is in today's world.
And what about the Commitment of Traders report? How often is that released, and what does it tell you as an investor?
Well, the Commitment of Traders report is released once a week. It usually comes out on Tuesday. I think it's released on a Friday, and you can't get it off the net for some time after that. It shows three major groups. It shows the commercials, the large speculators, and the general public, actually. And it lets everyone knows how the bets are being made. And I call them bets, but you could call them positions, which is the correct terminology. So the idea is in all commodities, not just gold and silver, but is that the commercials are the ones that know the most about the market. So, for example, getting off the gold-silver topic for a moment, if you go to a commercial wheat producer would be someone that grows a great vast amount of wheat, like ADM, for example. And the idea is that that grower would know, what their yield is, how much they planted relative to the previous year, how much is in storage, what the quality is. They know what the demand is coming out of other markets. So they have a really good idea of the total market picture. And so the idea is that a commercial entity in whatever the commodity, be it wheat, be it gold, be it soybeans or whatever, has probably more knowledge about the commodity than anyone else. So the commercials are the ones that most people look at to see which way they're playing their hand. Are they playing it, that the price of a given commodity is going to go up or down? And most of these commercials are short, meaning they're selling more than they're buying. And there's lots of reasons for that, and it has very little to do with what I just mentioned, which sounds ridiculous, but nonetheless that's a fact, because the hypothecation and rehypothecation, the ability to take these things and turn derivatives into derivatives and those derivatives into more derivatives and on it goes, is nothing more than a financial transaction. So these people have a lot of control over what they're doing with the overall, not so much commodity, what they're doing with these derivatives. And that's what's driving the game. It's the old tail wagging the dog situation. So I'm off on a tangent. Let me bring myself back in here for a second. So what you look at the Commitment of Traders is basically how the commercials are lining up against the large speculators. The large speculators, I'm going to come back to the metals only, so I'm speaking specifically on gold and silver right now, is the commercials are not necessarily mining companies, which are the ones that produce it, but they are the bullion banks that usually run what's called the books for the mining companies. And usually the biggest mining companies are conglomerates, or like RTZ and BHP. And these large conglomerates turn their books over to the bullion banks and the LBMA, which handles a lot of the base metal, physical metals like tin, zinc, lead, aluminum, that type of thing, nickel. And they allow these bullion banks to go in and speculate with the physical and the derivatives, which are multiples, many multiples of the physical market. And then on the other side, you have what's called the large speculators, which are basically trading funds, which, as many have pointed out, are usually mechanical trading algorithms that go long or short basis certain amounts of parameters, let me be more specific, based on price, based on volume, and based on trends. And usually they're wrong, and the commercials are usually right. Right now we're in a situation where the large speculators are, meaning the trading funds, are largely short the metals, which is an indicator that they're on the wrong side. They usually are. So if the metals were to go up significantly, a lot of these trading funds would be in trouble. So, and the last category is the general public. The general public is thought of as being the stupid money, but it really isn't. A lot of times they're really on the correct side. Not always. The public is generally long. They generally believe that, a commodity is real value, and therefore it has, some intrinsic value. You could go back to the wheat example, and, if a farmer knows that it can be grown for so much bushel and it's selling below that price, then obviously it's probably a good buy. There's a lot of reasons why some of these commodities will trade under their production cost, and it has very little to do with the common sense reality of what it would take to, produce it. It has, again, to do with the amount of derivatives that are out there and what the financiers are doing with it. The whole system has been convoluted, really, from its original intent. The original intent of the futures market, I think, was one that was very good and worthwhile and served its purpose. But unfortunately, with what's called the quants, or the mathematicians, making these algorithms and these high frequency trading platforms and all that goes on in today's real world, they become gambling casinos more than anything else.
And then you said something about cost of production, and you were also talking about miners. Are the miners are they making money at these prices, the average miner?
Barely. Again, I was going to answer it all stated. I mean, it depends. You have to go on a case-by-case basis. But if you pull them all together, and generally speaking, no, most of the gold and silver miners, that's their primary product. I'm not talking about a conglomerate like we just spoke about in the futures market. I'm talking about, a Newmont Mining, for example, or a First Majestic on the silver side, that their primary product is gold or silver. A lot of them are right near their cost of production, so there's very little margin for profit, or maybe not. So it's right at that point right now.
And then if they start to go out of business, would that cause a supply crunch?
Could. It would certainly tighten supply. And usually there's a delay in these markets. I mean, you could see a substandard price for the metals for, months before a company says, well, we're closing down, because it's actually cheaper, believe it or not, to make it a going concern, especially a mine, because mines are very difficult, especially an underground mine. So it's actually makes more sense from a longer term top view perspective to lose money on a monthly basis for a few months than close it down. Because once you close it down, the costs are actually greater to get that up and going again than it would be to just take a small loss month after month. I know that may not make sense. I didn't know that until I've been in the business for a while. But if you do the math, it actually makes sense, because look, you're in a business to make a profit. And if you can take a small loss and absorb it for a while, you're better off to keep it going than you are to shut it down. A bad analogy is probably like an automobile. I mean, if you've got a hot automobile that's an antique or something, but you put it out on the parade every now and then, you still want to start that engine up and get everything flowing through it like every month or so. You don't want to just leave it on blocks for years and years, where once you got to go to start it, everything's rusted out. That's a corny but similar analogy to a mining concern.
Yeah, that makes sense. And the silver to gold ratio is currently about 60 to 1. Is that a normal ratio? And if not, do you expect the ratio to return to a more historical average?
Well, it's not. The historic ratio is actually 12 to 1 or 16 to 1. And the best way I can explain it comes from Franklin Sanders, and Franklin's a friend of mine. And I'll just rattle this off. But if I had a chart that was 45 feet long, and every foot represented 100 years of human history, that would be 45 times 100 or 4,500 years. And the gold-silver ratio would remain under 16 for all but the last 15 inches. So let me repeat that. I've got a chart 45 feet long, and the gold-silver ratio will be under 16 to 1 for all of that 45 feet, save the last 15 inches. So that's the historic, and I don't care who you are, you can't argue with that fact. In fact, the first 40 feet, up until 1500, the ratio oscillated under 12 to 1 and spent most of the time between 8 to 1 to 12 to 1. And that's what I call the natural ratio. In those days, up until 1500, the ratio out of the ground was roughly 12 to 1, best we can tell from the data available. Only after the discovery of huge silver deposits in America did the ratio climb above the 12 to 1. And the ratio moved beyond that once the silver was basically taken out of the monetary system. And you've seen it as high as 100 to 1 a couple of times, actually. What the geologists think right now is the ratio is about 9 to 1. Now, just because a ratio in the earth is 9 to 1 or 10 to 1 or whatever doesn't mean that's the correct price to sell for. I get this often. A lot of people say, well, if it's 10 to 1, then, silver should sell at 1/10 the price of gold. And it sounds like it's common sense, but it's really in a free market, which we don't have, but in a free market, the market is going to determine how valuable it is relative to another metal. If you could, if you knew that the ratio in the ground is what the price should be, and some people, again, adhere to that incorrectly. I mean, platinum is 30 times rarer than gold. Why isn't platinum 30 times more expensive than gold? Well, because the market, as unfree as it is still somewhat free, and the market's determined that it's roughly priced about the same price as gold. I mean, if you want to talk about a precious metal, talk about the platinum group metals. I mean, the amount of gold that has been mined throughout all of human history is roughly, 3 Olympic-sized swimming pools or something to that effect. But the amount of platinum would fit in the average person's living room. I mean, get out on the moon and take a look down on the planet and think about all the automobiles down there, all the houses down there, all the roads down there, and then think, I'm going to zoom in and look for platinum. You got one guy's living room, and it's sitting there, a big block of platinum, and that's all that's ever been mined in all of human history. Talk about precious. Give me a break. Anyway, I'm off on a tangent, but I did it to make a point.
And what should that tell people that are gold and silver stackers?
Well, both those metals are precious as well, and they have held value throughout all of human history. And I think the most important in the physical realm is to, be real, buy real, get real, and have that because it's the only asset that's known as money through eons of time, and this is the most important part, is outside the system. If there was a bank run, if there was an electronic failure, if there was a hurricane and the ATMs went down, pick any scenario you want. I know that you do Prepper Recon podcasts, so there's a lot of preppers that listen to your show. And all of these things are possibilities, but gold and silver in your hand, something that you can actually, touch and own, is something that's recognized worldwide, and it can be used as a barter at any time, anywhere. Not to say that the first person you approach on the street would be willing to trade you something for a silver coin, but you wouldn't have to go too far to find someone that would. So this is something that is a vehicle that a lot of the Asians understand, a lot of people from India understand, but it seems that only very few percentage of the population in North America really get the idea that this is money outside the system. You don't need a counterparty. You don't need a broker. You don't need a banker. You don't need anything except to have it yourself. And you're in the driver's seat. You put yourself on your own silver standard, or you put yourself on your own gold and silver standard. And that's something very, very important. It's a concept that once the ship goes down, everyone will say, geez, I never knew that, or why didn't somebody tell me? Well, shows like yours are telling people. But nonetheless, they look at it as such a non sequitur, as something that's so remote, that's so unlikely to take place, that why bother? Well, a lot of people, during the Sandy incident said, why bother? And I wish they'd bothered. A lot of people in, the Katrina situation wish they had bothered. There's nothing wrong with putting a certain amount of assets in the gold and silver world, and for things not to go wrong. I'm not sitting here rooting for things to go, sideways to down. It's just my whole life has been spent studying the economic the economic consequences of a system based on a lie. And again, as we started the show, I think we're in a situation now where it's probably going to be within the next 3 to 5 years where the reality of how these systems unwind will be, facing us right there, right now, that type of thing.
Sure, and it doesn't take a Hurricane Sandy or even a Greek-style bail-in or systemic collapse. Just this morning on Judge Report, people were waking up to check their PNC accounts, and they were getting double drafted for their mortgage payments. So that can have a domino effect on people's finances if you were planning on that other mortgage payment that you weren't planning on paying went out, and now your credit card's not getting paid, and you've got your rent check bouncing, or, well, I guess if you've got a mortgage report, you don't have a rent check, but your car note check bouncing, and it can really get catastrophic fast. So it's important to have some money outside of the system. That's great advice. Now, the oil to gold ratio is currently 11-1, or 11 barrels of oil to an ounce of gold. Do you pay any attention to that ratio for precious metals trading purposes?
Well, I do pay attention to the ratio, but not for trading purposes. My trading abilities / how I do it is reserved for my Basic Plus membership. And what I do is I use the Camtasia software, and I come in and use a chart, and I show them exactly what I'm looking for and how I do it. So I think the oil ratio is, again, important to look at, but I don't use it for trading.
And what form should folks hold their silver for wealth preservation?
Well, I look at it, for most people, coins are probably the best. There's an individual choice. Depends if you're, a large investor or a small investor. You really want more units per dollar invested. I mean, if you have a choice of buying a 100-ounce bar or 100 one-ounce coins, you definitely want to take the 100 coins, because now when you go to sell back, you have 100, possible transactions, whereas with the bar, you have one transaction. So that's what I have taught for years. It makes the most sense. Most people, even that are fairly well off, are still better off with coins than are with bars.
And do you recommend silver for wealth preservation or for investment purposes, or for both?
Both. There's no question about it. You can read my website for the reasoning behind that.
And is there any difference in silver maples, silver eagles, and bars minted by private mints? And do you have a personal preference for any of those?
No, again, on free market, I think people should buy what they think is their best personal choice. You pay more. I mean, I'll be consistent in the 10 rules of silver investing, which you can get off of my website for free, by the way. You just have to go to silver-investor.com and sign up for our free letter, not our paid service. And I'll give you the 10 rules of silver investing, which were written years ago. And I say in there to buy the most silver per dollar invested, which would mean a silver round, which is a privately minted 1-ounce silver medallion or coin, versus a government stamped one. It's the same exact thing. It's 0.999 fine silver. It's the same weight, same everything. So it's identical as far as where it would be on the periodic chart. What the difference is that some people want to pay the extra money to have it minted by Canada or have it minted by the U.S. And if that's the case, then by all means do it. If you do not have a preference, and silver is silver to you, and that how it manifests to me. In most cases, I have eagles, I have maples. Then I would prefer to get more silver per dollar. The reason being is that on a sellback, you usually don't capture the premium on the government minted coins. Now, there is an exception to that, and I want to state it because I've done a special report on this, and I've done it on the radio just a couple times. There is no coin series that's ever gone forever. You know, the Peace dollar, for example, or the Morgan dollar, both silver dollars, they ended. And the Silver Eagle program will probably end at some point as well. And it could be not that far off. I mean, it could be, a few years from now. I don't know. But in the case that it were to be a few years off, let's say, 3, 4, 5, something like that, then anyone that's holding eagles would probably see a premium into those coins because the series was stopped. So that's something to bear in mind. I wouldn't put, a lot of stake in what I just said and say, oh, geez, David said this, we should really get eagles only or something along those lines. What I'm trying to do is be objective here and explain why you could get a boost in a series like Maple Leaf or Silver Eagle, because if it were to take place during your lifetime, the odds are favorable, but not guaranteed, that you could see a premium built into that coinage, and it would continue to maintain that premium.
For somebody that's just starting out to put a portion of their wealth into silver for wealth preservation purposes, and they're planning to do that this year in 2014, should they buy all they can at once, or should they try to spread out their purchases?
Well, as far as I'm concerned, and again, this is outlined in the 10 Rules of Silver Investing, dollar cost averaging is the best. You can go to silver123.net. That's www.silver123.net. For more information, you can just set yourself up on a dollar cost averaging program. It really takes the emotion out of it and instills discipline into the investor. As long as you're in a bull market, I'm convinced that we still are, then buying the same dollar amount every month is a lot better way to approach the market than trying to pick a top or bottom. Not that I don't time the market, I do, and I've done well, but not perfect. But that's more for a sophisticated investor. For the average silver stacker or gold stacker out there, the best thing to do is just be disciplined. It's like an exercise program. Exercise your pocketbook to buy something real for you and your family every month, what you can afford. And again, that silver123.net is a very good way to set it up.
And where should we keep our metal? Do you prefer a home safe, safety deposit box, or some other means of storage?
Well, I actually think you should have some nearby. Again, you do the prepper show. What good does it do you if it's, buried across town or you can't get to it easily? So I actually recommend that you have some nearby. But I also recommend you should probably have it spread out in 3 places. 3 doesn't mean 10 or 12. I'm getting too old. I probably couldn't remember 12 places. But having it spread out is also a good idea. So, have some handy that you could use if you needed to. And then have another place or 2 that, you trust. It could be with a family member. It could be in a different jurisdiction if you're wealthy. I mean, there's lots of opportunity to leave to the listener's imagination. But it's always good to, spread it out. And again, I think 3 is sort of the magic number. If there were to be confiscation, which I really, really doubt, but others that write on the website have a much different view than mine. Some people believe that it is going to take place. Again, I doubt it highly. If you had it in 3 places and they came to your house and you turned it in or whatever, you still have 2 other locales, So there's a lot to be said to spreading it out somewhat.
And for those that want to speculate in the silver market, could they use ETFs for that purpose? And if so, are they all created equal, or is there a difference between, say, an ETF like SLV versus Eric Sprott's ETF, PSLV?
Well, first of all, I'm, free market, as I've said during the interview a few times. So if you want to, use the ETFs, by all means do so. My basic take on it is if you have your physical amount, bought and paid for that you can touch, then you want to speculate using, the futures markets or ETFs or options or whatever else. by all means do so. There are differences. I've addressed those in the Morgan report. If you just want to do some in and out trading, the SLVs probably works as well as any. If you want to have a large quantity that you want to take delivery on, then the PSLV makes more sense, because you can take delivery from that one. In most cases, you cannot. So it just depends on the person, what their objectives are, what their time frame is, and what they really want to do with the metal.
And you've made some pretty good calls in the past as far as picking the tops and bottoms of the silver prices. If someone wants to speculate in the silver market, they'd probably benefit from the information in your newsletter. Can you tell us a little bit more about that?
Yeah, I'd love to, and thanks for the question. I think there's some ideas out there about, what I do and how I do it that probably are not factual, and that's okay, because a lot of these people, see my public domain information only, and they've never bought a membership. They've never seen our best thinking is for people to pay us, obviously. They've never seen one of my videos on a trade that I performed, or when I got, did well. I mean, I got in at 19 and rode it all the way up to 48. I mean, some people will be with me forever on that move. And I got out. I got out at the top too. I mean, it's important to get out at the top than it is to get in at the bottom. But here's the idea. One is I am one that can invest and speculate both. And excuse the aside, but not everyone can do that. And that's an idea that I've observed. Some people can do one or the other. Some can do both. I do both. Now, I never have more in a speculation than I have in my core assets. In other words, I roughly have 75% invested, and at the most have 25% in a cash position that can be used for trading purposes. So the idea is that since I'm such a believer in this market, in the precious metals markets, that the lion's share of it is in an investment stature, which is basically buy and hold. Not that we don't weed out the portfolio or sell some of the losers or cash in from time to time and that type of thing. But that's basically an investment mentality. As far as the trading mentality, I'm a position trader, not a day trader. So anyone that's interested in, buying into the membership service, thinking I'm going to have a trade of the week or trade of the month or whatever, forget it. That's not how I work. I wait. I'm very patient. I let the market tell me when to get in, not when I want to get in. That's something I learned the hard way. But nonetheless, so I do both. I let the market give us cues on when to do it, and I do both. So it's not something where you see some of these guys on the internet, well, he just trades, or no, I do both. I do both well, not perfectly. I'm willing to admit when I'm wrong, especially when you're, using leverage. And then on the stock side, most of our people that are on the membership service are buy and hold stock investors in the precious metals, which we divide from top tier to mid tier to speculations. And the speculation side, I'm extremely adamant about it. You bet a little to win a lot. You don't bet a lot on some of these speculations, and they're very difficult. We've had a great track record up until probably the 2009 or so. I'm sure my members might say, well, wait a minute. And we've had some losers all the way up, but we've had a lot of winners back in the earlier days. These last 2 years have been extremely, excruciatingly painful for precious metals stock investors. I know I'm one of them. And we've had a couple what we thought were extremely good calls, researched out, as well as you can be in, high integrity or not, which, I claim to have. Some of these went south on us. Just no way to tell in advance. I mean, if you take me back in time and have all the data that I had available and say, would you do it again? I would have, because one of these was one of the richest gold situations on the planet. It was coming back online, and, I hate to blame management, but certainly they should be blamed for part of what transpired. We didn't see it coming. So, on the speculative side, it's extremely tough. I do expect the new year to be much better this year, 2014, for not only the metals, but the mining shares as well. And again, I'm very disciplined in what I do and what I teach, and that is, big serious money goes into big serious company. Mid-sized money, money that would hurt if you lost it, goes into mid-sized companies. And money you can afford to lose goes into speculations. Unfortunately, most people in this industry that write in the newsletter field do nothing but dance around these speculative penny stocks all the time. And believe me, that is not the place to be. I've been there. I've done that. I learned that lesson the hard way in my 20s. I'm, past 60 now. And what I have learned is that there's ways to make good, solid, safe money, sleep at night, and take some of those profits and recycle them into these penny stocks. And you only want to add to these speculative situations if they bear fruit. And I've done that. I haven't done it lately, but I have done that, in the earlier days, the 2000 to say 2008 time frame, when the market was kind of on a bull run before the financial panic of 2008 took place. And of course, from there, I actually got in at the bottom. Miscalled that bottom, by the way. I thought 1250 was about it. Look at a chart; it held there about 3 weeks. It fell down into the below 9 actually in the futures market, but you couldn't buy any physical silver for less than about 13.5. Nonetheless, you could get it off the exchange, which is what I did. I bought 3 bars at about $9 each, or $9 the ounce, not per 1,000 ounces. That would have been a nice buy. So 27,000, and I had them minted in a half-ounce medallions. But nonetheless, I'm probably off on a tangent again. The point being is that I do both, I teach both, and not everyone is suited to both. So the service is set up. If you just want the newsletter, you can get that. That's a very low cost, especially for the amount of work and effort and the team that we have. And then if you want to go one notch up and not only get the newsletter and see the buy and hold positions, but also want the market timing, then you can go into what's called the Basic Plus service, where I do the videos and all the videos we do on these mining camp tours and that type of thing, plus the videos I do when I see a trade, be it the bond market, the metals market, the dollar, whatever. I go through a lot of different markets and point out what I see is happening.
Well, David, that's just a lot of really, really great information. Thanks so much again for coming on the show. We'll have links in today's show notes to your website and also to purchase your book, Get the Skinny on Silver Investing. We'll have a link to purchase that through Amazon. But for the folks listening on iTunes, Stitcher, and YouTube, can you tell them one more time where they can find you?
I think the easiest is use a good search engine like Google. Google's the most, known. Just type in David Morgan Silver. Make sure to put the silver after David Morgan. Hit search, and it'll bring up our blog, the YouTube channel, the Twitter feed. It'll bring up everything. So David Morgan Silver in the Google or a good search engine, you'll find us.
And David, thanks again for taking time to come on the show today.
Mark, my pleasure. Thank you.
I've been purchasing gold and silver from JM Bullion since before they were a show sponsor because they had the lowest over spot price of any dealer I've been able to find. JM Bullion now offers free shipping on all orders, and Prepper Recon podcast listeners will get $5 off any order over $300. Just go to jmbullion.com and use coupon code PR5 at checkout. Hey Preppers and Patriots, my new book, American Exit Strategy, Book 1 of the Economic Collapse Chronicles, is now available in audiobook format through Amazon, iTunes, and Audible. Of course, you can still purchase the Kindle edition or paperback edition through Amazon as well. God-fearing patriots and those who believe in the Constitution will find this near-future dystopian novel to be right up their alley. Those who are looking to be more informed about the potential threat to America's financial stability will learn what to watch for and how to prepare themselves for an economic collapse. In Book 1, America is on the cusp of financial annihilation. Matt and Karen Baer face the challenges of Main Street during a full-scale financial meltdown. Government borrowing and monetary creation have reached their limits. When funds are no longer available for government programs, widespread civil unrest erupts across the country. Matt and Karen are forced to move to a more remote location, and their level of preparedness is revealed as being much less adequate than they believed prior to the crisis. Meanwhile, Paul Randall, a third-party presidential candidate, arises to push back against the welfare and warfare spending that have bankrupted our country. Paul Randall proposes a plan to mitigate the coming hyperinflationary collapse, which is a mathematical certainty. His plan is known as the American Exit Strategy. American Exit Strategy uses survival fiction to take an in-depth look at the real-life politics and economics behind the issues that are likely to trigger a currency collapse or financial meltdown in the near future. American Exit Strategy is a work of fiction until it becomes history. Get your copy today at AmericanExitStrategy.com or through Amazon. God bless and happy prepping.